Hi, Richard here on Thursday the 16th of September, starting with our usual chart of the Dow daily. Again, noticing the test of resistance. Risk appetite, I think, is the key thing here. You know, there's no question that the S&P 500 has been moving up 9 out of the last 11 days. We had a problem with volume a few days ago, but that volume is now increased. But the key question is, what's it likely to do? So to answer that question, there's two alternatives. One is that we're going to push up this Fibonacci extension here about the 10,640 odd mark, and then come down and retest what was previous resistance, which is now support. That would look to drive on up through that, and possibly as high as 10,850. In the event that the failure occurs, and there's certainly some argument to say that the end of this rally is just about done, and that's pretty much because of the breadth and volume that we're seeing is somewhat muted. The real issue, I think, is whether or not we get an impulsive move to the downside. So that's what we need to be on the alert for, and certainly from a trading perspective, if there is this weakness, it is displayed and it looks impulsive, then we should be aboard that to track it down, because my goodness, as we can see in these last down exercises, when it unravels really quickly. So we've taken weeks to get to here. It can take days to get back down to here. So looking at the Australian market, similar situation in terms of strength. It's not really there, even though it's been pushing up, and of course that's been a bone to the Australian dollar, but resistance is still intact at 4,655 is the upper level, or indeed, I'm sorry, that looks like 4,675 based on what I've put on there, which is a Fibonacci retracement. And in the event that these five waves, and let me just show them to you. So we've started here, up for 1, down for 2, the longest being the third, down for 4, up for 5, and that's now reached a height of 4,675. We'd be looking for an A, B, C correction, a three-wave correction, back down to about 4,500, possibly as low as 4,450, or if things get really a lot weaker, and of course we'd want to be on this at 4,400. But we'll have to have a watch of the internal technical structure of this wave as it unfolds, but we'd be looking to get on board, down for 1, up for 2, and around that 2 mark. That'll give us some sort of target to go short on. At the moment, difficult to trade. The Aussie dollar, we can see also that it's come up in those 5 waves, up 3, 4, and up for 5 to complete a target which was 93.30 to 93.40. Indeed, it went higher. It spiked up high to 94.50 and then sucked back down, and it's just below this previous double top line, which was in place from December 2009, and of course the right double top in April 2010. So here we are again in September 2011. Exactly the same place. So ABC correction would offer opportunity, as indeed support. If it did find it off this 92.86, we'd look to go further north to 96.75 as a target. This chart is both the euro and the US dollar, and I wanted to explain the differences to you. The US dollar really at the moment is at the heart of all activity as far as gold and the stock market, and indeed the currencies. So we can see the US dollar went up to a high of 89 back in May, sort of mid-May this year. It fell short of what was then an original target, which these lines have been in place actually on a weekly chart for a long time. This is a daily, but 89.58 was the target back then. It didn't occur. But I looked, once we hit the 5 waves up, which this is the pinnacle of, and you can see those reversal candles there, they're very clear. I looked for retracements, and we got these targets set here at 83.45, and then indeed 81.46 was a secondary target. So they've been in place for some time, but as we look at the structure, it really was all about this wave 2. So we're up for 1, which was the breakout from this really vicious descent, up for 1, down for 2 and 3 in two waves. Sorry, in A, B, C in 3 waves. So up for 1, down for 2, and we thought with this bullish candle here that we were going to get a breakout, and the continuation was going to occur, and we were going to get that third of a third, which would also see a reversal in the stock market. So the up for 1, down for 2, up for 3, the third of a third, giving us down in gold and down in the stock market. Clearly that has not occurred. So this wave has actually extended further to the downside. You can see that in fact it's a mini head and shoulders. There's the left shoulder, there's a head, there's the right shoulder. So the target was in fact probably spot on at about 81 on the US dollar. I think what's important here is that we're looking for support, and in the event that we find support and that goes up, then this will see the euro, which is the mirror opposite. You can see that there's the same leg in inverse as this down leg here, and then down for 1, up for 2, and then we're expecting a rollover, and then down for 3, and this will be a particularly powerful leg in the event that it unfolds as we forecast it to. But we know that the risk appetite is up at the moment, so it's really a matter of just standing by and seeing what's going on. So underneath that is a chart of the gold, and I've moved this trend line. Of course, where I had it before was really very tight, and we were expectant as it broke through, came back up, retested. We're expecting for it to continue on down to the longer term trend. It did not occur that way. Clearly the US dollar index bounced up. Let me see if I can get that back up to put it beside gold. Not quite identical, but certainly is at the heart of it. You can see that this rise up here is in fact the impulsive nature of gold, which really was not in alignment with the traditional relationship of gold. This is more in alignment. You can see the push down here in the US dollar index, and you can see the opposite move for gold going back up, and of course this has taken out the previous high at around 1264.5, and we have an expectation for that to head on north to around the 1291 would be the first target. I've said 1300 in previous videos, and indeed if it was to go further than that, we'd be talking about the 1340 odd mark in the event that support is found. So all we can do is put that support line there in that new place. That would become a stop if you're long. So 1235 is the stop. We'd look for further activity here, and in the event that line was broken, that would take you out of any long that you're in. And I had a chart of Newcrest which I thought was worth showing you. This is a daily chart. We can see this what looked to be correctional, and we were coming down for 1, up for 2, and indeed it came down for 3, but these were equidistance. I haven't measured them for some time, but I'm sure that if we did measure them, we're looking for a 1-for-1 type relationship, and there it is exactly. So this leg and this leg were identical, meaning that is correctional. That's your A, B, C 3-wave movement overlapping, and sure enough we've got this 5-wave impulsive move to the upside now. So Newcrest is not a trade that I had on the chart at the moment. Certainly it's been a trade, a stock that we've traded in the past quite successfully, but well, I had a different view on gold, and I felt it was risky to put us into that trade. But nevertheless, if you were trading it, you could quite easily put your stop under that, and that would have become a stop. Then this would have become a stop at 34, so sort of 35 odd dollars, and now you'd be running this straight up here, and you'd be enjoying that rise, which of course has taken out the previous high over here at 39.75 odd dollars, and we're now currently tracking at 39.50. You know, what will gold do if it does find support? This will come back in a little correction, find the support, and continue on for a target, and I can measure that quickly. A target of say $41.60, $41.60 would be a reasonable target for that, whether it corrects and finds support and goes up. But there it is. That's the report for today. And remember that the US dollar index is really at the heart of all of these moves. Risk appetite, the conversion of bonds. You know, the US government's talked about further quantitative easing, which means raising $1 trillion in the sale of bonds. Clearly, they need to sell US dollars to get that money, and that's one of the reasons why the US dollar index has been pushing down, and of course the euro pushing up. However, we're on standby for further economic signals. There's no question that Europe is still in a mess, and you know, things are very fragile. So don't be surprised if we see some pretty rapid downside. All right. Please go to themarketforecaster.com.au to see all the charts in more detail.